Hello everyone and welcome back to my channel where we break down the complexities of the stock market into the bite-sized pieces. In today's video, we're going to talk about the exchange traded funds or ETF and explore one that's gaining traction amongst retail traders. If you ever feel overwhelmed by the absolute sea of individual stocks, ETFs might suit your needs. Retail investors often face a daunting task when trying to identify the promising stocks with limited information and also a lot of technical barriers. It can make this process a challenging one to spot those hidden gems. But don't worry because ETFs are here to simplify that game. Think of them as treasure chests that contain a variety of stocks with strong growth potentials. Instead of searching for that elusive needle in a haystack, you now have the entire haystack, needles and all, at your disposal. So let's explore one such ETF that has caught the attention of many retail traders. Different ETFs serve different purposes, catering to various sectors and investment goals. In previous videos, we have talked about Schd, the Schwab US Dividend ETF, a crowd favorite amongst investors. Today, we shift our focus to another player in the game, the WisdomTree US Quality Dividend Growth Fund, trading under the ticker symbol DGRW on the Nasdaq. So DGRW, the WisdomTree US Quality Dividend Growth Fund, is like a financial superhero for retail traders. This ETF is designed to provide exposure to companies exhibiting both quality and growth potentials. By holding a basket of carefully selected stocks, DGRW allows investors to tap into the success stories of multiple companies without the need for in-depth research on each individual stock. What makes DGRW stand out is its focus on companies with strong fundamentals and a track record for consistent dividend distributions. This combination of quality and dividend growth can be a winning formula for long-term investors seeking stability and income. In this video, we're going to look at the WisdomTree Dividend ETF, how it compares to other popular options on the market, and what would be the best trading approach given the circumstances. Now, before the rest of my video continues, if you like what you see so far, please consider to drop a like, comment, and to subscribe. And please check out other video analysis regrouped in playlists on my channel page. With that being said, let's get into today's topic. Recently, DGRW has been trading at around $70, marking a 1% decrease over the past 5 days, but a 2% increase over the past month, along with a 6% increase over the past 6 months, with a bottom around $69.40. It's worth noticing that DGRW has been trading higher over the course of the past 12 months or so, with an increase at around 14% during this period, currently priced near the ceiling of the ongoing channel. DGRW is a diversified dividend fund with a large number of positions known for their stability and brand power to deliver dividends to the holders. With an expense ratio of around 0.28%, it's a bit more expensive than Schwab equivalent Schd that we have talked about before, with a yield that's almost identical to around 3.7% at the moment. It's been trading publicly since 2013, and options are available for those who want hedging and exposure increase purposes. The ETF is very much invested into the large caps as they represent 97% of its holdings, which is understandable given the nature and purpose of DGRW. One key difference to note between DGRW and Schd is the field in which these exposures are located. DGRW seems a bit more invested in the tech sector in comparison to Schd, that is more vested in the traditional sector. This means that while the first glance will suggest that DGRW may enjoy bigger growth potentials, it's worth noticing that its top two investments, Microsoft and Apple, are both highly mature players in the tech field and already priced very high. This is why we should be prepared for some price correction if the recession becomes priced in by the market. From a dividend perspective, DGRW has seen its dividend fluctuating with the market performance and certainly a bit less calibrated compared to the counterparties such as Schd, but maintains an overall tendency of edging higher. What's important to note as well is that DGRW has a monthly distribution schedule, and the current records show that it has always been able to make distributions to its holders every single month. With that being said, here are the technicals. The trading volume of WisdomTree US Quality Dividend Growth Fund is around 985,000 shares versus the average volume of 656,000 shares. Over the previous 52 weeks period, the price fluctuated between $8.98 and $70.46. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and there is enough liquidity to support a trading strategy. If the float is thin, it would be very easy to push the stock price around, but with the same low liquidity could also mean that any sort of exit could be delicate. When we compare the current volume against the average volume, there might be the possibility for trend reversal or the breakthroughs if differences are too large. For instance, if the stock were to break through, the current volume would be much higher than the average volume. The assets under management by DGRW is currently at around $11 million. As we compare the current price to the historical price fluctuations, the stock is 3% higher than the 1-month low, 14% higher than the 3-month low, and 18% higher than the 52 weeks low. On the options market, which often gives us a hint on the market sentiment on where the stock price is likely going to head next, the implied volatility is 13% compared to a historical volatility of 8%. The put-call volume ratio is currently at around 100%. It's normal for many stocks and equities and ETFs to have a higher put option volume than what they deserve, as many institutions serve these as hedging tools. The most recent volume traded is around 2 contracts a day versus the average of 14 over the past 30 days. In terms of open interest, the most recent volume of open interest is around 233 contracts versus a 30-day average of 207 contracts. In terms of the shareholder structure, institutional shareholders own about 67% of its outstanding shares. The biggest shareholders include PNC Financials, Bank of America, and Morgan Stanley. It's always encouraging to see some institutional participation when holding a stock long-term, because it may offer a layer of stability and a token of reliability in the medium to long run. It means that the market is overall confident that it's going to deliver value in the long term, which is an important factor to consider for long-term holding. I believe that the minimum threshold to be considered a good investment-grade stock should be around 30%, although of course many exceptions may apply. The current short interest is around 365,000 contracts on the total float, and 74% of those transactions come from the dark pools. Typically, if the short interest were above 15% of the total volume, and many of them come from the dark pools, it may suggest institutional positions taken to short the stock, thus enhancing the potentials of a short squeeze. But currently, with only 365,000 contracts out of like 160-something million shares trading, I don't believe that a short operation is necessarily going to tip the balance of anything, and I also don't believe that there is much of it. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one, the idea or the concept of cyclic movements. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Overall, my recommendation for DGRW is to consider it as an investment position that plays a stabilizing role in your portfolio to parry any volatility that may negatively affect your positions. The timing may not be the best to commit the majority of the capital, but a slow build over multiple months or years is certainly the best way to go. I would recommend to commit between 5 to 8% of your portfolio into DGRW over the time period of around 6 months and above, so that you may have ample time to purchase in case of pullbacks and retracements.